Welcome to the deep dive. Gold prices are, well, they're really grabbing headlines, aren't they? Getting close to that $3,400 USD mark, a record high.
Absolutely. And if you're watching your gold investments or even just curious, you're probably asking yourself, is it time to sell? Or, could I miss out on even more gains if I do?
Exactly that feeling. So, our mission today really is to dig into the data, look at what the big investors are doing, and try to help you make a decision that's based on insight, not just, well, emotion.
Because that excitement, or sometimes that fear of missing out the FOMO,
Yeah.
it's powerful. But we need to ask, is this peak built on something solid? Or is it mostly that FOMO talking?
Right. We've had persistent inflation, haven't we? Uncertainty around what central banks will do next, central banks themselves buying record amounts of gold, and of course, all the ongoing geopolitical stuff. Those have definitely been tailwinds for gold since 2024.
Precisely. Yeah. But it's so important for listeners to grasp the difference here. Is it real fundamental support pushing the price up? Or is it just momentum, just the expectation that prices have to keep rising? One feels solid, the other. Well, that can be pretty precarious.
Okay, so let's unpack this rapid climb. Past $3,200, heading toward $3,400, peak, or perilous plateau. What's your initial gut feeling?
Well, what's really fascinating, I think, is looking at who might be driving the bus now. Initially, you probably had, the more informed financial players getting interested.
Right.
But when prices accelerate like this, you often see a new wave of money coming in. And that wave can be driven much more by that fear of missing out, maybe less by a deep fundamental analysis.
So who is really pushing these prices up? Is it the central banks, the long-term strategic folks, which, you could see as a reliable signal?
Potentially, yeah.
Or is it more individual investors, maybe short-term traders just playing the charts? That feels, well, less stable, doesn't it?
It really raises a big question about sustainability, doesn't it? If it's central banks diversifying reserves, that signals a certain conviction. But if it's mostly individuals chasing momentum,
Yeah.
that's a much more fragile situation.
It really takes me back to 2020. Remember that? Gold shot past $2,000.
Oh, yeah.
Everyone was buzzing about $2,500, and then bang, a pretty sharp correction. And as our sources pointed out then, it wasn't because gold suddenly became worthless.
No, not at all. It was just
No.
over-enthusiasm, too much buying based purely on emotion, on speculation.
Mhm.
The market got way ahead of itself.
That's such a key lesson, isn't it? Especially now, seeing these new highs.
Yeah.
So, okay, let's follow the money. What's the trading activity telling us?
We're definitely seeing a big pickup in volume across physical gold, but also the paper markets,
Yeah.
futures, ETFs.
Okay.
And what's really striking, actually, is reports from major exchanges, especially in Asia and Europe. They're seeing a significant number of new investors entering the gold market.
And why is that potentially a warning sign?
Well, historically, when you see a huge influx of new, often less experienced, investors pile into an asset that's already run up a lot. It can suggest the market's being driven more by momentum, by the narrative, than by fundamentals.
Like people just jumping on the bandwagon because they see the price going up?
Exactly. They don't want to be left out feeling.
So, if you're holding gold right now, maybe listening to this, it's worth asking yourself, how am I feeling? Am I excited watching that price tick up every day? Or is there maybe a little voice asking, this is getting a bit frothy?
That's a great self-check. That feeling, whether it's pure excitement or a bit of unease, and valuable info for you, really ask, am I holding this based on my long-term strategy, or am I just caught up in the fear of missing the next leg up?
Because gold, fundamentally, it doesn't generate profits like a company stock, right? No dividends, no growth in that sense.
Nope. Its value really comes down to confidence, to
Yeah.
belief.
So if the price runs way ahead of what you think its fundamental value is, then it's mainly psychology holding it up.
Pretty much. It's supported by that shared belief that someone else will buy it for more tomorrow. And market psychology, as we know, well, it can turn on a dime. It's fragile.
Which brings us to a really sharp point from our sources. Everyone's watching who's buying, but maybe we should be asking, who's quietly getting ready to sell?
That is a very, very smart question, because the really big market turns, they're often driven by these large, sometimes silent capital flows, not necessarily by the loudest voices in the room.
So for you listening, are you just glued to the daily price chart? Or are you trying to get a sense of what the big players, the institutions might be doing or thinking about doing?
It's so easy to get caught up in the day-to-day noise, isn't it? But the strategic view involves looking at those larger flows. What are the big funds the central bank's doing?
We know some central banks, China, Russia, Turkey, Kazakhstan, they've been pretty steady buyers. but probably more for strategic diversification, right? Not just chasing price.
That seems to be the consensus, yes. More of a long-term defensive play. But what about the big ETFs, specifically the giant one, SPDR Gold shares?
Yeah, what's the story there?
Well, it's interesting. After some solid buying earlier in 2025, their activity seems to have, well, cooled off significantly. There have even been some small outflows, some selling.
Huh. That seems counterintuitive, doesn't it? Prices soaring, why wouldn't the biggest ETF be loading up?
It does seem odd on the surface, but large institutions often work differently. They tend to buy when there's fear, when prices are beaten down. They often sell into euphoria, into strength.
So SPDR being quiet or even selling a bit, could that mean they see this rally as maybe being driven by that FOMO and perhaps view these levels as a decent place to take some chips off the table?
That's definitely one interpretation. Their reluctance to chase the price higher, it signals a potential lack of deep institutional conviction right at these record highs. That's a really crucial difference compared to some past rallies and maybe a bit of a red flag.
So while Main Street might be dreaming of $4,000 gold, the big money might be quietly heading towards the exits.
There are indications, yes. Reports suggest some major investors are starting to rebalance, maybe trimming their gold exposure, moving into things like short-term bonds, cash, safer harbors. It's a classic defensive shift when perceived risk goes up.
But someone listening might say, hang on, the price is still rising. Why sell now?
And that's a fair question. But for these big players, selling now isn't necessarily about calling the absolute top or abandoning gold forever. It's about risk management, locking in profits.
Especially if they bought much lower.
Exactly. If you bought gold between, say, $2,000 and $2,800, you don't need $4,000 to make a very healthy profit. This $3,300 to $3,400 range, particularly when technical indicators might be flashing overbought, can look like a pretty good spot to reduce exposure.
And you mentioned trading volume earlier. Is there something else going on there?
In some markets, yes, there's this potential divergence appearing. Prices are climbing, but the actual number of shares or contracts changing hands isn't always keeping pace.
Like the enthusiasm isn't fully backed by commitment.
Kind of. Think of it like a party getting louder, but fewer people are actually arriving. Lower volume on rising prices can suggest weakening underlying buying power. Maybe that retail sentiment is becoming the main driver. And markets dominated by retail sentiment, well, they can be more vulnerable to sharp reversals.
What about the big investment banks? Are they all calling for $4,000?
That's another interesting signal. They're not all jumping on that bandwagon. You see major banks like JP Morgan, Morgan Stanley. Their public forecasts are often more cautious. Maybe, an optimistic case hits $3,500, but they also talk about a possible correction, maybe back towards $3,200.
So no universal consensus up there.
Not really, no. And that lack of widespread agreement among the big analysts, especially at record highs, suggests the conviction isn't universal. That itself introduces risk.
Okay, let's put ourselves in the shoes of a fund manager. Sitting on, say, a 30–40% gain on gold in just a few months. They see the hype, maybe some frothy expectations. Interest rates are still relatively high. The US dollar isn't collapsing. What's a logical move?
For many, the logical, prudent move is to start taking some profit. Gradually reduce the position, lock in those gains, maybe move that capital somewhere else that looks less stretched risk-wise. And often, this happens quietly, bit by bit.
So the really crucial question for you listening is, who are you aligned with right now? Are you potentially buying just as some of the smart money might be starting to sell?
And crucially, do you have a plan? What happens if SPDR, just hypothetically, decides to sell a significant chunk one day? Does that trigger a stop loss for you? Or are you just hoping for the best?
It really boils down to looking beyond the price sticker, doesn't it? Understanding the flow of money, who's buying with conviction, and who might be looking for the exit.
That's where the real insights often lie.
Let's dive a bit more into those ETFs and interest rates. You said the strong ETF buying we saw in past rallies seems muted this time. Why is that such a big deal?
It's significant because that ETF accumulation, especially by giants like SPDR, was a major engine in previous big gold runs. Their current relative quietness, despite record prices, is telling. It suggests the big players, the market makers, are maybe more hesitant this time. They're observing, perhaps, rather than actively leading the charge.
You brought up 2020. What was SPDR doing then?
Oh, massively buying. In 2020, amidst all the pandemic uncertainty, SPDR gold shares added over 400 tons of gold. Huge inflow. And that coincided with gold jumping about 30%.
But then things changed.
Yes, by late 2023, as interest rates rose sharply, making yield-bearing assets more attractive, We saw SPDR consistently reducing its gold holdings. Big capital shifted away from non-yielding gold.
So fast forward to mid-2025, gold's flying high again. But SPDR isn't repeating that massive buying. Why the hesitation now?
Well, several possibilities. Maybe they also see this rally as less fundamentally supported, perhaps too speculative. Or maybe they just think $3,400 is frankly too expensive given the alternatives.
Like the opportunity cost. Holding gold means not holding something that pays interest.
Exactly. That dynamic hasn't vanished. And for big ETFs, caution is baked in. They do serious risk analysis. They absolutely want to avoid being the bag holder, the last one buying at the very peak.
So they're sitting on the sidelines or just nibbling. Isn't just about volume, it's about conviction.
Precisely. It signals their level of belief or lack thereof in the sustainability of these prices.
And if the biggest player lacks that strong conviction, what does that imply for the rally's strength?
It really calls into question how long these levels can hold without that kind of broad institutional backing. If a major buyer like SPDR is hesitant, it might suggest they anticipate a pullback. Maybe they think they'll get a chance to buy lower later.
You mentioned some specific data for early 2025.
Yeah, the numbers showed some modest net buying by SPDR in March and early April, but it was tiny, just over 6 tons total. Compare that to the massive inflows in previous bull runs. It's a stark difference. And crucially, many of the recent big daily price jumps in gold weren't matched by significant ETF buying volume.
Implying what?
It strongly suggests this current rise is being fueled more by individuals, maybe smaller institutions. Actors who are often quicker to react, maybe quicker to panic sell if sentiment turns.
So back to the listener holding gold around $3,300, $3,400, it's about understanding which side of that flow you're on, right?
Absolutely. Are you potentially providing the supply for smaller buyers, or are you relying on the big ETFs to eventually step in and support prices when they currently seem reluctant?
It's about having that strategy before panic sets in.
Because in finance, strategic action beats hasty reaction every time. And right now, you've got hesitant major ETFs, signs of slowing central bank buying, cautious institutions. The main driver seems to be crowd sentiment.
Which can change very fast.
Incredibly fast. A negative headline, a Fed announcement, something unexpected out of China. Anything could shift the mood quickly.
It really does echo that 2011 peak, doesn't it? Gold hit $1,900.
Yes. And that period leading up to the 2011 peak also lacked strong ETF support. It was followed by that multi-year bear market. It makes you wonder, are we seeing a potential repeat in 2025?
History certainly offers some warnings. That 2011 experience is a big one. Pushing towards $1,900, everyone thought $2,500 was next.
And then it eventually crashed down below $1,100 over the next few years. It's a potent reminder.
And you always hear, this time is different, but often.
Often the people saying that are the ones who get hurt the most when the correction comes. So the question is stark. Is this climb to $3,400 built on rock-solid foundations, or is it echoing a past bubble pattern?
Gold is a safe haven, we know that, but that doesn't make it invincible to market cycles.
Not at all. History shows these big gold surges are often tied to specific events, geopolitical crises, economic anxieties. When those specific drivers fade, gold can fall back. Not because it lost its intrinsic quality, but because the expectations supporting that high price evaporated.
And looking around now, you've got big funds already holding gold, central banks have bought heavily, retail investors are piling in. It feels a bit like late 2021 for Bitcoin, perhaps.
There are parallels, certainly. When participation is widespread and the belief in perpetual upside is strong, the critical question becomes, who's left to buy? Who is the next wave that can push prices even higher from these already unprecedented levels?
Because at these high prices, the fear can shift, right? It's not just fear of bad news, but fear of missing out more.
Exactly. And when everyone expects prices to keep rising indefinitely, you paradoxically run out of buyers. Everyone who's going to buy is already bought.
That's a tough thought for someone who maybe just bought in around $3,200 or $3,300.
It is.
Yeah.
Because if that new money inflow dries up, and if some of the early birds start taking profits, those recent buyers risk not just missing more upside, but actually catching a falling knife, buying into a decline.
We saw that happen after 2011. People kept buying as it fell through $1,500, $1,300.
All the way down to nearly $1,000 by 2015. Millions were caught.
Because the psychology is always, this time it's different.
But the market mechanics often remember, We've had rationales before, the European debt crisis for the 2011 run, COVID in 2020, Ukraine in 2023. Now it's inflation, Fed policy, China buying.
Yeah.
Are these really enough to justify endless gains after a $1,000 jump in about 15 months?
So the issue isn't the reasons themselves, but the expectation that they'll keep driving new buyers in.
Precisely. Expectations are that double-edged sword. When they get overblown, disconnected from the underlying reality, the disillusionment can be swift and brutal. Corrections of 20–30%, like we saw in 2013 and 2015, are entirely possible, especially if that institutional support isn't there and it's mostly anxious retail holding the bag.
Let's go back to that fund manager. They bought at $2,500, $2,800. They see $3,400. Would they take profit?
Logically, very likely yes, or at least start trimming significantly. It's prudent risk management.
And if enough big players think that way,
The market can turn fast, often before most people even realize what's happening.
and we are seeing those potential signals. Cooling ETF buys, maybe China's massive accumulation pausing, other central banks less active.
Exactly. So the challenge to you, the listener, is if the big players seem to be easing off the accelerator, are you comfortable staying fully invested, betting on further gains based more on hope than on observable market dynamics?
History doesn't repeat exactly, but the lessons are there.
And maybe the biggest lesson from past peaks is this. When prices are at all-time highs and everyone is convinced they're going much higher, you might actually be nearer the end of the current cycle than the beginning of a new one.
That historical context is just so vital, isn't it? Grounding the excitement.
It really is. Bring some realism.
So, okay, let's bring it home. Gold's near $3,400. The big question for you listening, sell it all, hold tight, maybe take some profits off the table. Obviously, no single right answer for everyone.
No, it's always personal. But a guiding principle should be, try hard not to make decisions driven by peak emotion. Those price peaks often line up perfectly with peak excitement, peak FOMO.
And those are exactly the times to be most cautious, right? Our sources flag those warning signs. Your account looks amazingly green. Everyone you talk to says hold.
Right.
Mainstream finance predicts crazy high numbers.
Yeah, when you see all that aligning, that's your cue to pause. Take a breath. Really think about your plan, your risk tolerance.
It's a good point that sometimes the biggest win isn't buying perfectly, it's selling smartly, or at least prudently.
Absolutely.
So one strategy mentioned is maybe taking, say, 30% to 50% off the table at these kinds of levels, $3,350, $3,400, maybe $3,450. What's the logic there?
Well, taking partial profits does a few things for you. One, you lock in some real gains. That reduces stress, knowing you haven't let it all ride.
Peace of mind.
Definitely. Two, you still have skin in the game. If gold does keep running, you still benefit. You're not totally out. And three, crucially, you generate cash. Cash gives you options, maybe reinvesting after a dip or putting it elsewhere.
Managing risk, staying involved, creating options makes sense, and it comes back to why you bought gold initially, doesn't it?
It really does. Was it a core long-term holding?
Yeah.
A shorter-term hedge? Were you just riding the trend? If you were trend following, trends don't last forever, so maybe an earlier exit makes more sense.
The main thing seems to be, have your plan before the market forces your hand in a panic. Don't wait for a $200 drop to suddenly wonder what to do.
Exactly right. Think back to 2020 again. Gold peaked near $2,070 and dropped to almost $300 pretty fast in less than 2 months. The people who had an exit strategy, even if they didn't sell at the absolute top, probably slept a lot better than those who held on, hoping for a recovery that took nearly 2 years.
So, wrapping up, near $3,400, nobody can tell you definitively sell now or hold forever. But if you don't have a clear strategy for taking profit or managing risk after a $1,000 plus run-up in just over a year, well, maybe you're leaning more towards speculating than investing.
That's really the bottom line, isn't it? The price could go higher, it could reverse sharply, but making choices based on understanding the dynamics we've talked about, rather than just gut feeling or excitement, that's always the wiser path for you.